Previously on Dry Powder.
Web3 has attracted over $90 billion of equity investment.
Thomas Olsen, global co-lead of Bain's Web3 and Metaverse practice, described the fundamental building blocks of Web3. Today on the show, Thomas and I will discuss how the leading private equity firms are building out their Web3 capabilities.
When we talk to those teams, it's very different than talking to a fund who really is not up the curve yet. It's a completely different conversation. They're not networked. They don't really have their finger on the pulse in the same way.
We'll also explore how private equity firms are using tokenization to reach a whole new class of investors. I'm Hugh MacArthur, head of Bain's global private equity practice, and this is Dry Powder. So let's try and make this tactical now, Thomas, so people can understand how one might actually make intelligent bets on Web3 technology. How do they think about, for example, no regret moves that investors should be taking now if they're not fully up the curve on Web3 and all of its potential?
The first thing is you need to define your posture on the topic. Too many times the posture is they don't have a posture or it's unclear and you haven't thought about it. You need to do the thinking to say, what is our posture on this topic? Do we want to be aggressive? Do we want to be a fast follower? Or do we want to really just wait and see what happens? And then also within that, break that down by use case or topic. Is this important to our fund strategy and fundraising? Is this important to our tech investment team and their hypotheses? And then once you break that down into different levels, you can say, well, I need to hire a team, or I need to build a capability, or I need to start looking at how I might use this technology for my asset raising. So I think that's the basic nature. And that's an exercise you can do pretty quickly, but have that posture clear, and then you can revisit it. But I think the worst place to be in is to not have a clear posture and appetite defined.
How do you actually ensure that you can do rigorous deal sourcing in these universe of 5,000 companies that you mentioned?
We've tried to develop a number of themes across Web3. You have some of the really core technology, the protocols, the layer 1, layer 2 blockchains. There's that level. There's basically software tools to build on blockchain. Then you have the biggest component of the investment, which is the financial infrastructure, which all the custodians, the exchanges, that part of the infrastructure. And then you have really all the consumer-facing applications where you have gaming and luxury good NFT type of companies and all the more the consumer applications. So if you break it down thematically, and then within those themes, you can look at ones that are earlier stage and later stage and larger. That's an interesting way to break it down. And so depending on the mandate you have and what kind of team you are, you can focus in on a certain type of theme there that's useful.
We've talked about a wide range of industries and technologies that are under the hood of what we might call Web3. How do you ensure that your team actually has a comprehensive view of the space?
First, we've been lucky to work pretty intensively across various different types of clients on this over really 10 years. The work that we're doing also is to try to stay connected with the ecosystem of experts. We have a fairly proprietary group of about 300 experts we frequently interact with to understand changes. The good news I'd say here is that there are a lot of passionate young people on this that are way up the curve. We have people on the team that are in their 20s that have spent 8 or 10 years really, really thinking about this. We've had people that have done their own mining of Bitcoin. They've developed secondary digital asset markets and gaming. And these people are world experts. So I think that's the same in some of the investor clients. They have the 25-year-old can be really a world expert on some of these topics.
That's fascinating. Can you actually share an example of a private equity firm that stood up a team of experts like that and developed some type of formula or flywheel for repeatability?
The VCs are the most obvious example. And there's a number of those that developed a fairly large team to do it. Not that it completely prevents some mistakes on some investments, obviously. But I think maybe more interestingly is what the larger traditional funds are doing. I think they've taken passionate people from already inside the fund to work on it. And they've been diligencing companies, making some initial more conservative types investments to start getting used to it, participating in some of the fundraising processes, also with some of the corporate venture capital teams. So I think there's a number of examples. One big traditional fund has 2 dedicated Web3 teams working on it, and they probably diligenced 100 assets. And when we talk to those teams, it's very different than talking to a fund who really is not up the curve yet. It's a completely different conversation. They're not networked. They don't really have their finger on the pulse in the same way.
So putting some specialized resources on it that have horizontal capabilities to look across the range of technologies and sectors and opportunities is key to making a serious investment. And then what I think I heard you say is you don't want to get very speculative at the outset, but you do want to put your toes in the water and invest in things that you have some confidence in once you get up that learning curve. Is that right?
Yeah. And also, it's not just about the investment team capability, it's also the investment committee. So how do you start building a point of view on this for the investment committee level?
So the 25-year-old black belts that are the world's leading experts may need to convince some 50-year-olds on the investment committee of the economic viability of some of these investments to give them the confidence to actually pull the vote lever to yes on some of these deals.
Yeah, and I think you need both of those things.
Makes a lot of sense. One of the things we've talked a lot about in the show in the past is the evolution of the private equity space itself. We've talked about the democratization of private equity. We've talked about individual investors playing a much bigger role with technologies that allow digital platforms and tokenization, providing access to investors in a way that simply didn't exist 3 to 5 years ago and seem to be coming down the rails at very, very high speed right now. What is your view on how Web3 could impact private equity fund strategy? And do you see funds using these technologies to reach new investors?
I think that tokenization of private equity funds is one of the most interesting concrete use cases that's in motion right now. The main objective is clearly to reach individual investors with a different workflow and different cost structure. A number of large funds have publicly done this or announced they're doing it. Apollo, KKR, Partners Group, and many others. There's existing and regulated private asset exchanges like ADDX in Singapore and T0 in the US, as well as direct models like what KKR has first done with Securitize. It's not that it's the only way to reach individual investors, but the tokenization of a fund could enable the efficiencies that you have in public market infrastructure. So the issuing to secondary trading mechanism to administration and custody that is at a level of scale and efficiency that is far beyond private market levels today. And some of the features that it can develop, a liquidity mechanism, even if it's a quarterly tender or a monthly tender, type of model where you have a transparent liquidity mechanism and customized models for the assets, unlocks lending against those assets as collateral. So if you think of the feature for individuals, if you could deliver a liquidity mechanism and margin lending type of model against the private asset, that's a very attractive feature for that 1 to 2 million to 20 to 50 million type of investor. It's not really well served today by the current model. And for the wealth manager, the ability to provide leverage on that portfolio like they do with public securities is also very interesting, not just for the investor, but for the wealth managers as a source of interest income, which is a very important part of a private bank and wealth manager income streams. So I think that model is very interesting, and it's developing pretty quickly.
I hear you talk about things like tokenization and this model that's evolving, Thomas. And when I very frequently have these conversations, I always get the buts, the but compliance, but valuation, but all of the things that are not there that make these types of capabilities everyday usable today. I've always been taught in my life, even though I am a self-confessed Luddite, to never bet against technology because technology will find a way to solve these problems. Are you in the bucket that we're going to be solving these problems over the course of the next year or two, and that these types of technologies will be very commonplace in the private equity markets, or do we have 3 to 5 more years to wait?
Well, I would say my experience also with years of frustration with some of the enterprise blockchain adoptions, it's not primarily a technology problem. Let's say tokenizing a fund. The regulatory framework is fairly clear. We're not inventing a new type of asset. It's just a workflow problem. So I think to unlock this at scale, it is a question of building that workflow with wealth managers and private banks, with scale custodians, which luckily State Street and Bank of New York and Northern Trust and all the big custodians are very advanced on this topic of digital asset custody, and building the workflow for them into their standard kind of compliant workflows that they have. And that's going to take a little bit of time at scale. But we've also learned from all of our customer research that the vast amount of that wealth prefers to go through their private bank or their wealth manager or their RIA. They don't want to open some new account on the internet or something to do that. And also just structurally the cross-asset portfolio guidance that a wealth manager or one of those platforms provide in a lot of ways leads this to be the main channel to do this at scale. I think that will take years, not months, but you'll see early examples of that already over the next 1 or 2 years at some scale.
It just seems like there's a big carrot dangling out there that's really driving this convergence that we're talking about. And that is that half of the world's investable wealth really does belong to individuals and family offices beyond institutions. And if you look at the private asset penetration of that 50% of capital, it's extraordinarily low. And so the desire for asset managers to have access to those pools of capital and the desire of those individuals and family offices to invest in potentially higher returning assets that actually generate alpha are going to commingle. And whether you are a Fidelity or a Vanguard or a BlackRock and your Bain business is distribution and you need product to distribute, or if you're a large alt and you have lots of content, but you don't have the distribution muscles and you need to have a wealth management channel of some sort to get to market, and you've got wealth tech companies trying to solve this, it seems like all these pieces are coming together that's going to make this a reality, in my view, sooner rather than later. And it might be, Thomas, that in a few years' time, we're going to be asking what is an alternative investment anymore and how is it different from other investments if I could buy and sell these things on a daily, weekly, monthly basis.
Oh, that's completely our hypothesis on financial markets, is that private and public markets are fundamentally converging because partly of that workflow. Technology is making the workflow of custody and trading and administration of private assets much more like the public market infrastructure. And that enables a lot of these use cases.
It certainly sounds like a very exciting future. Let's see how fast it goes. Is there anything on your mind that investors should be watching for in the years ahead?
The timing question is really the biggest question and biggest challenge. And the timing of this and how fast it advances will be impacted by regulation in a significant way. Some of the recent problems in the crypto space will maybe move regulatory development from a crawl more to a fast crawl or walk. That will make a big difference in how a lot of these use cases develop. The one thing we didn't talk about, which I think is a little bit farther out on this convergence question, is you can tokenize the fund, but you can also tokenize the individual assets within the fund. And so if you start tokenize the individual, say, equity within a private equity fund, you can also start having some secondary liquidity within the fund to try to shift and risk manage or portfolio manage that fund. And it starts looking more like maybe a big bank credit balance sheet where they're actively managing the risk and trade-offs in that portfolio. That's another interesting thing for me that I think is a little bit farther out probably, but again, another step towards convergence between private and public type of market management.
It's a fascinating series of insights, Thomas, and two big takeaways that I inferred from what you just said, interestingly, is that all of this chaos that's going on in the crypto markets right now, far from leading people to throwing the baby out with the bathwater and saying this stuff is crazy, is actually going to, in your mind, encourage more regulation to move faster so that the industry actually develops more rapidly as a result of this chaos versus being called into question. And that leads to me to my second inference, if I'm right, which is you're basically saying that Web3 is now in the too big to fail status. Like we are not going back. We are not speculating in something that's not going to arrive and have this infrastructure, have all of the use cases that we're talking about. But the regulators and everybody else need to solve these problems to take the chaos out of it so investors can actually get into the business of making money with it. Is that fair?
That's fair. The conviction that I have comes from the conviction that the large incumbents have on this topic, and it's new technology that enables efficiencies that are important, and there's a lot of conviction behind that. So they'll find a way to make that work with the regulated structures and compliance, and business models will, over time, develop that. Another just anecdote is over the last, say, 6 months where you've had some of the company collapses you've seen in the Web3, we've heard incumbent clients say, this is a window of opportunity. This is a chance for us to hire talent that we couldn't get before, to purchase some of the high quality Web3 type of company capabilities we need. So there's a conviction there around a lot of the incumbents on moving ahead that's not really impacted directly exactly by what's happening. And they're able to differentiate between the leverage high risk kind of blow ups and the fundamental potential of the technology and tools.
Well, Thomas, I've learned a tremendous amount today, and I wanted to thank you again for being on the show because I think it's going to be a fantastic listen for everyone involved with dry powder. And I'm very excited now, where I was very worried about the world of Web3 and crypto, that the future is going to have some amazing things for our investors and all of us.
Thanks for having me.
If you'd like to learn more about Web3, please click on the link in the episode notes. I'm Hugh MacArthur. Thank you for listening.